In today's market update, we are going to take a look at the factor that is most responsible for stock market prices going higher over time. Also, we have just heard from the 4 big tech companies, and their increase in AI spending for 2026 is going to blow you away. And then lastly, what would be a video if we didn't talk about silver and gold? And we've got that for you. Let's dive into it. Now, before I get into the market update, don't forget to like and subscribe to our channel. That way you don't miss future videos. And we're going to start off today talking about, like I mentioned earlier, the factor that's most important, most responsible for higher stock prices over time, and that is what is happening with company profits. We are now nearing the end of fourth quarter earnings seasons. We've heard from about 75% of companies in the S&P 500. Coming into this quarter, expectations were profit growth was going to be just over 8% year over year. And I should mention that last year, the stock market went basically 4 for 4 during earnings seasons, meaning profits came in much, much higher than expected all 4 reporting seasons, and we're off to a great start this year. What you see right here, the S&P 500 has averaged or is on pace for a 13.3% growth rate. That's opposed to just over 8% expected just a month and a half ago. And if you take a look down at the different sectors, you notice technology is number one, 30% profit growth year over year. We're going to talk about tech again in a few minutes. Industrials doing very well, 23%. That's part of that is due to the build out of AI with these data warehouses that are being built around the country. Communication services, that is the category that Netflix and Google are in, are up 14%, and financials are up 10%. So those are the most important sectors. Double-digit growth for all of them. We're very happy to see that. I also, every year or every quarter, like to look at what Visa, Mastercard, and American Express have to say, because again, they have the best view of consumer spending of any companies in the country. And you see the slide here. I have a sentence from each that is pertinent. Visa's CEO said payments volume grew 8% year over year, demonstrating resilient consumer spending. Mastercard, we heard that the environment is supportive and continue to see a healthy consumer and business spending. And then on American Express's CEO said, we're really bullish from a consumer perspective. Take a look at the growth rates though. Visa, Mastercard, and Amex, revenue growth of between 10 to 18% and profit growth of 15 to 16%. Listen, for the last 3 or so years, there have been a lot of analysts every year who have thought a recession was coming, and especially at different times during the year, like last year when we had the tariff rollouts. If you just listen to these 3 companies, they have told you, even when there are analysts out there who are negative on the consumer, they have told you that the consumer is still spending, is still healthy, and is still resilient, and they are continuing to say that again. That again is a check mark we like to see. The last thing on earnings that I want to highlight here before we shift and talk about tech a little bit, this chart I have in front of you takes a look at companies in the S&P 500, the percentage of them that are having increasing estimates for 12-month profits and 12-month revenues. So this goes back to 2000 when it's going up. Estimates are going up for companies. When it's going down, you get the point. What I want to highlight are both of these now. Revenue growth, 82% of companies, their forward numbers are going up. 77% of companies have profits going up. And those are some of the highest numbers outside of early in the COVID recovery period. You have to go back to 2019 to have had this good a news. And here's why this matters, because there were periods in the last couple of years where negative analysts said, look, tech's doing real well, but the rest of the market, not so much. Well, this is telling you here that around 80% of companies, their forward guidance are going higher. So when you put all that together, this is why we said in our 2026 Outlook video that we thought the markets could do well this year. It's not going to be in a straight line, but profits are the most important factor, and those are going higher. Now on to technology, and we just looked at earnings growth for tech for the fourth quarter was 30% year over year. Astounding. Let me tell you what has happened though. Tech stocks over the last 3 months or so have underperformed the rest of the market. Tech peaked in late October. And so there have been some out there who have said, hey, tech had an amazing run for 10 or 15 years. Now that run may be ending. We don't think that's the case, and that strong of earnings growth is a big reason why. But when it comes to AI, that played a big role in some of the profit growth. We like to see what are the big tech companies doing on the spend. We had a chart just about a month ago in our 26 Outlook where we talked about what the big tech companies were expected to spend in 2026. At the time, it was around $400 billion. And you can see that in the middle column there down around, it says 410 billion. 2025, now that we got the full numbers, they ended up spending 360 billion. However, we heard from Amazon, Google, Microsoft, and Meta, and we have new numbers. That's on the far right. Amazon has gone from just a month ago, expectations of 130 billion to 200 billion. Alphabet, Google has gone from 100 billion to 180. Microsoft, a much smaller increase, 100 to 105. And then Meta there has gone from a range of 80 to 90 billion to 125. So when you add these up and listen, these are large numbers. People's eyes can start glazing over when you talk about this. But just think about this. We were sitting at 400 billion and now it's 600 billion expected for these companies. And here's the thing, the dollars that they're spending are other companies' revenue and hopefully profits, meaning there's a lot of other companies out there that are going to be the recipient of much of this money. The biggest winner is NVIDIA, the company that sells the chips needed to power all of these applications. But when you take a look at this, we come in the camp that these companies are already seeing the positive return on investment they need to justify further spending, and none of these companies want to get left behind. And speaking of that, let's look at the scorecard. And this is cloud compute AI. When you hear that, that's what we're talking about. Amazon's number one. They have 28% market share. Microsoft, their unit is called Azure's number two at 21%. Google is number three at 14%. And then there's a lot of other companies with small numbers. So this is what is at stake. Companies want to go up on this scorecard, and they think they need to spend that money to get there. Now, the last thing I want to mention is another reason these companies are spending this much is because they have orders to take on more customers in the future. This is called their backlog. And right now for 2026, there is a backlog, and beyond, there is a backlog of $1.1 trillion. That is a huge number. By the way, Microsoft is number one there. They have over 600 billion of backlog. Half of that is OpenAI, who is the ChatGPT owner. So when you have numbers like this, you can understand why these companies want to get every dollar of that they can. In our last video in late January, we talked about the parabolic moves that silver and gold had recently, and we're trying to answer the question, hey, if I have not invested in this area, is now a good time? And the first thing you needed to know is a lot of money was going into silver and gold at that time. In fact, with silver, you can see this is a chart of flows into silver on looks like every 3 or 4 days, maybe. basis here that this is looking at, you can see that silver had the highest number by far right there as silver was getting up to its highest level of all time. And by the way, all the money that's come in the last few weeks is more than what we had seen in the previous 3 or 4 years. So in other words, silver had a huge up move, and a lot of people decided, is now a good time to invest in silver? Well, this says that they thought it was a good time. In the video, I mentioned that there were warning signs all around, and the downside was getting to be very significant if history was any guide. We put that out on a Thursday in late January. Literally that day ended up being the peak. This silver ETF hit $110 a share, and you can see it has had a precipitous fall. In fact, it got as low as $66. That is a 40% sell-off, and it did that in 1 week. It's bounced back a little bit. Now it is down about 33% from where it was in late January. But here is the point that we were trying to make, is that a lot of people don't understand when they hear about how much an investment's going up and they see charts of it going up and they see commercials, they get excited and they want to go in. And we said, look, we've seen this happen time and time again. The investment vehicles change. We saw it with crypto in 2021, with EV stocks at that time. We saw it with the dot-com tech names back in 99, 2000, but the patterns are very similar. And a 40% loss in 1 week, there's very few people I know who are okay with that kind of volatility. So hopefully you were not somebody who put in a lot of money when silver was at the top there. But again, we wanted to check back in. Now, speaking at gold, gold also had a decline. It dropped 16% in just a week. It's only down 10 right now, but we said we viewed that a little bit differently because central banks around the globe are buying it on a weekly basis, and that has been support for gold. Now, eventually, we do think that gold is going to have a much bigger drop later in the year, but silver was the one that was very dangerous just 2 weeks ago. So for our last topic today, we are going to talk about energy stocks. And because what I was just saying about silver and all the excitement just a few weeks ago, well, this is a slimmed down version of that. If you've listened to CNBC or Fox Business in the last couple weeks, you hear a lot about energy stocks because they actually are the top performing sector as we come up to 6 weeks in 2026. They're up double digits. And one of the things that's happened is now a lot of analysts are saying this is a great place to put your money. Here is a chart of the XLE, which owns a lot of the energy names, though Chevron and Exxon make up about 40% of this fund. This goes back to 2012, and you can see for about 10 to 12 years, these stocks went nowhere, up and down, but you made no money. But if you take a look over the last, say, 6 months, this has had a nice move and is now up at a 10-year high. Here is the problem. As a result of that, money is now flooding in. And in fact, here you can see energy funds just had their second most amount of inflows in ever. Okay, so people are hearing about how well they're doing. They're piling money in. Here's the problem. If you look at the factor that is the most important to determining company profits in the energy space, it's what's the price of oil. And looking at that, you can see it is sitting right around the $64 range, which is very close to the lowest level that it's had in the last 5 years. Oil companies made a lot more money back in 2022 when oil was up between $90 and $120 for most of the year. Well, that's not going to happen now. We're in a much different place where there is a wave of supply both in the US and around the globe. The other fact that's very important is valuation of these oil stocks. They were cheap at a time, but that time is not now. And in fact, this is looking at the PE ratio, basically how much times the earnings, the profits these companies are making or these shares trading for. This is Chevron in purple, Exxon in orange, and both of these stocks are now trading basically at almost 2 times their average PE ratios. And say it another way, Chevron is now trading at a higher valuation than those big tech companies I talked about earlier, Nvidia, Microsoft, Meta, which is crazy because most of these oil companies are growing at 2-3% per year, while the tech names are growing at 15, 20, 25, 30% per year and are going to continue to do that well into the future. So again, we're telling you these things. This is what we do for our clients. Try to keep them from making mistakes like piling into silver when it was up at all-time highs and like investing in the energy stocks now. Speaking of jumping into a crowded trade like silver, that is one of the portfolio red flags that we put together. There is a list of 10. If you're wondering what red flags do you have in your portfolio, you can click the link below and download a copy. So the key takeaways is that earnings season is off to an amazing start in 2026. Companies' profits have grown at a much higher rate than they were forecast to. That is now 5 quarters in a row that has happened. And on the tech AI side, these companies are spending a lot more money and are going to continue to in 2026. But these are some of the best managed companies in the world. We think they're making the right decision. Listen, if you have not seen us before, and you can go to our website at centerracapital.com and go to the contact page and reach out. If you'd like to have a conversation, we have a 3-meeting process to see if we are a good fit. And if you aren't getting these kind of updates from your advisor, we'd love to talk to you. Thanks for watching and take care.